Have you ever wondered why some traders always seem to know when to buy or sell? The secret lies in mastering key elements of technical analysis, including charts, trends, support and resistance levels, and volume. In the previous video, we discussed the first element of technical analysis, the chart. We briefly explained the three main types of charts: line, bar, and candlestick, and talked about their uses. If you haven't seen it yet, click the link above to watch it. Let's dive into trends. In the market, there are three types of trends: uptrend, downtrend, and sideways trend. This means that the market is always in one of these phases, either in an uptrend, a downtrend, or a sideways trend. An uptrend means prices are rising, and traders feel optimistic. As long as there are no signs of reversal, the upward movement continues. On the other hand, a downtrend means prices are falling, and there's a prevailing sense of pessimism. In this case, sellers have more control than buyers, and prices are expected to keep decreasing, until signs of a reversal or weakening trend appear. A ranging market, however, means prices are bouncing between two levels, highs and lows, with no clear trend. There's a relative balance in the market, and neither buyers nor sellers have the upper hand. The market will remain in a range until it breaks out of these boundaries, either from the top or bottom. So, how do we determine if the market is in an uptrend, downtrend, or range? If we see prices consistently making higher highs and higher lows, it indicates an uptrend. If prices are making lower highs and lower lows, it signals a downtrend. If the price is fluctuating between two levels with no clear breakout, the market is in a range. Identifying trends. Traders often rely on tools and indicators to identify and confirm market trends. The most common tools for identifying trends are trendlines, moving averages, and price action. A trend line is a clear, identifiable line drawn on a chart by traders to connect a series of prices or represent the best fit for a set of data. This line helps traders visualize the potential direction in which the value of an investment may move. A moving averages is a smooth representation of price action over a specified period. When prices are above the moving average, it indicates an uptrend. When below, it indicates a downtrend. Using price action, trends can be identified by analyzing the price movement on a chart without relying on indicators. Traders look for patterns, such as higher highs and higher lows in an uptrend, or lower highs and lower lows in a downtrend. How to trade trends. 1. Trade with the trend. The trend is your friend, is a common saying in trading. Traders look for opportunities to enter positions in the direction of the prevailing trend. 2. Trend reversal. Watch for signals like double tops, double bottoms or bearish, bullish divergence to anticipate potential trend reversals. 3. Trend continuation. Patterns like flags, pennants, or wedges often indicate that the current trend is likely to continue. Here's a brief explanation about trends. In the next video, we will discuss the third key element of technical analysis: support and resistance levels. Don't forget to subscribe to be notified when it's released, and give us energy with your likes and comments. See you soon.